Hello everyone, welcome to Smart Investing. So today's video is going to be about the banking sector. I have about 5 stocks and we're going to go over fundamentals, technicals, and some quants. So let's begin. First stock that I have up is KRNY. As you can see, these are the 5 stocks that I have. This one's going to be the first stock, second stock, and as always, I'm going to start from the bottom, working my way up to the top. So the first stock up, the name is Kearney Financial Corp. Again, not all of these stocks are in the banking sector. I think there may be 2, maybe 3 that might be in a similar or related sector. So it might be consumer lending. So basically, they just strictly offer like one service and they specialize in that one service. But banks, obviously, they do all kinds of loans and, they work with various, firms and stuff and, all that other good stuff. And they work with agencies and companies and all that. When it comes to consumer lending, it's a little different. They're just tighter restrictions and they work with less people basically. So first page up, we're going to look at the price and all of these numbers on the first page. Again, this is my first page, so what we see is what we have. And again, for some information, for the analysis part, again, I might not have the full information, but with this first page alone, this should be okay and enough for me to actually decide whether or not it should be on a watch list. Hopefully, it is enough information. If not, I'll still look at the analysis for what the other info has to offer, and I'll still see how much info they give me, and hopefully it can, back up the information that I have here on the first page. Hopefully it's good enough info and strong enough information to support, all these numbers basically. So first things up, market cap, like always. It's not bad, especially for the banking sector. You really don't want to see, a really small cap for a bank. This is a concern. So I like this. This is a concern. Only a $3 move within the past year. I get that we're in a downtrend, but then as you can see, if you see my videos, I do a 5-year chart. As we can see here, this stock is pretty flat. If you go to the low for the last 5 years, I wouldn't say the lowest, but if you were to see like a range, it would be from here. And I would say, how many points are there touching? I'd say for the low, I'd say about here. So we're looking at about $11 actually. I'm trying to touch this point here. So yeah, we're looking at about 11 and 10 cents. So then we can touch other points here and we're looking at about $12. So from $11 to $12. So basically a really tight range and a definite range. You're looking at about $11 and $12 minimum, and then a maximum of a difference of $4. So the $4 difference would be from 10 to 14. And those are just guesstimates, generous guesstimates, because we have the 52-week high and low right here. But again, that's a real concern. I don't like that price movement for the year. This I like. That's not too bad. And the PE, it could be slightly undervalued. I like to see it more around 12, not closer to 13. And then obviously they pay a dividend of 44 cents, and the dividend yield is 3.5. Like most investors, they love yields. They don't really care about earnings or anything. That, like, the first thing they see is yields, and that's pretty much it. They just want to add on to those yields. Everybody has their own preference, but again, that's really not the way to invest. The way to invest is to look at everything. You got to look at the 52-week high, low, the market cap, everything that I do. You got to do a full analysis, because some people, they'll just say, oh yeah, they're positive earnings, and it can cover the dividend, and then look at the yield, and then that's it. You have to do a full analysis. You can't just look at one factor and that's it. So again, this chart, so we have here a tight stop from 12 bucks all the way to 11.40. So if we open this up, make this narrow, so we have a support and a resistance level. So again, I'm using the EMA 50 and the EMA 200. Those are usually strong guidelines as to price ranges. If you don't know anything about charting or anything about technical analysis, this is just very, very basic. Again, I'm using EMA 50 and 200. These are long-term ranges, price ranges. So as we can see here, this one's a 50, this one's a 200. So basically, I'm using these price ranges as to what's a good price range for the long term. So we have a low of like around 11.40 will be a decent price, and a high of like 11.90. And again, that's only like 50 cents away. Again, this is not a stock that I like, but I'm just showing you a price range anyway. So we're gonna move on to the next factors and the next piece of information that we have, and that is the analysis for the quants. So again, I showed you a little bit of technicals. Excuse me. So again, a little bit for the technicals. It's an active stock, but again, I'm not crazy about the technicals. So the technicals, I'm gonna say it's a fail, but for the fundamentals, I'm gonna say a thumbs up. That's a pass. So it's a 1-to-1 vote. I'd say it's a 1-to-1 vote. So the tiebreaker is gonna be the Quant Rating. This is more of a overall rating as to what best fits this type of stock. So it's telling me that the value is the best factor. Then for growth, overall rating is close to a 7. So that's actually pretty good in terms of overall rating, and compared to the whole stock market and compared to this sector and similar sectors. Then number 2 came for income. I wouldn't actually agree with that. Then we also have quality, momentum, and growth. Value and the income for those two. I only checked it because that's what it showed me from Webull. But for my rating, I'm gonna say no for value and income. It's hard for me to give an overall rating, but what I'm trying to do is, out of these 5 factors for the quants, I'm trying to see what best fits this stock, like my analysis on it, what I think, what fits it best. Income, definitely no. Let's just go through that, and then the value. So again, based on a 5-year chart, it seems to be flat. You know, yes, it has dipped a little bit since April, and then start to go up like in mid-July. But again, if you look at that difference in price range, that's only like $1 move, and that's absolutely nothing. So as for value, you're not really getting any total return back. So obviously that price movement, even throughout the year and the last 5 years, it's awful. So I'm definitely gonna have to disagree with the quant rating for value because there's no price movement. And then for income, that is too low of an income. If I'm not seeing $1 in total return for the year for any stock, just for any stock, that's just a standard. That is, for me, that is a standard number. Just one. If you're not getting $1 at least, then it's just not even worth it. Really. Not worth it at all. And I'm being generous because of how high prices are. Now we're going to look at the growth, quality, and momentum. As for growth, again, I don't see it happening. I could be wrong, but again, we're already in August. Most of the year's already gone. And a lot of whatever stock took off these past few months, especially this last month, close to the last 2 months, those are the stocks that are most likely going to be doing good throughout the whole year. And this is not one of them. Yes, they have positive earnings. Let me look at the... So I said growth, quality, and momentum. As for growth, I don't see growth. As for momentum, I can see a little bit of momentum based on the volume. And then we can actually see, let me look at something real quick. Let me look at the last 3 months. This is typical for the past month because so many stocks have done good. I don't know what they've done for the earnings. I don't know how well they performed. But to be honest, for the value, again, it's not too bad. Because again, like I said earlier, it's close to a 12. There's other metrics to see what is a good value. I know for the banking sector, it's not the PE. I believe it's one of these two. It's either price to sales or price book. Again, I'm still learning that, but again, just overall, it's just not worth it for this stock. It has a low turnover rate, which is good, but overall, it's just, yeah. I don't. The only one I see is momentum, but I wouldn't even rate it that high. So for quality, I just don't see it. Just don't see much quality for this stock. We're gonna read a little bit about it real quick. So the bank is in New Jersey, Savings Bank. Just like a typical bank. So nothing special about this bank. I'm gonna look at dividends. So yeah, we're gonna look at dividends. So they are doing rising dividends every year. They haven't had any splits, which is good. And we're just gonna look at some numbers here. So we have here ROA. Let me see if they have annual estimates. Again, annual. I give it a few seconds. It's not giving me anything. Like always, and then revenue is still not working on this app. So it sucks. So compared to other banking companies, the debt is slightly lower than other companies. So I think that's gonna boost up the quality a little bit. But again, overall, I just don't like stocks that are too much in debt. That's just the way I like to choose my companies. Um, it is a high risk, and I know banks do that, but it's just I'd rather use the alternative. And again, banks don't even pay that much in dividends, and then the price movements are just very, very slow. They're just slow and stable. They're just there really just to be like a safeguard because the government needs them, but uh, to have the bank, to have a stock as a bank, I don't like it, and personally, I don't think it's a good selection. There are other related stocks, like I said, that are better than that. So for KRNY, I'm gonna say no, and we're gonna move on to the next one. Next one is CIVB, Civista Bank Share. So we're gonna move a little bit faster this time. So we can see 340. That I do not like. This is kind of low. The value is pretty good. The earnings are pretty good. And then the dividends are no. Um, the volume is pretty low. Let's look at the chart real quick. Gonna look at a 5 year. Again, this is another stock that looks flat. A lot of chops for the year. You know, these are big chops. These are very big chops. Very volatile. If they were small, like this one here, that wouldn't be too bad. But you see these big jumps, and again, I'm not looking at price. I'm just looking at based on how high and how fast and how far these jumps are going. I just don't like that on a chart. I just don't like it. Obviously, when it's over a longer time frame, you're not gonna see as much. But that's why when you look at the 1 year, you see a better depiction of it. You see more accuracy as to how volatile and just better price movement in a shorter time frame. I wouldn't say that short, but still you can see the movements on it when it's a 1 year. So again, it looks pretty flat. I'm not crazy about it. I don't like it. Overall, I'm saying no. So fundamentally and technically, those are both no's. No, no. And even if everything was good for the quants ratings, I can't approve it. So majority vote automatically for the analysis 2-1. Um, so 2-0, I mean. And so growth for this company, I don't see it. Sorry, I just don't see it. Income, I don't see it. Value, quality and momentum, uh, value. I see some value just because it's slightly undervalued based on the PE. But again, what I consider valuable, if it's undervalued and it actually had some decent price movement, and then I just don't see that. And then obviously a lot of stocks have low turnover, but the thing is that even with that, it's just not worth it. And so, I don't even have the full numbers. I don't even have the full numbers to analyze. So as for momentum, I'm gonna say no. The only one that I can see really is just value, and just I'd give it like maybe a 4 or 5 on value. I give it a 5. The reason being the PE is pretty low, which is good. But again, the price movement doesn't support it, especially for a 1 year or 5 year. And then the other thing too is that even if it remained flat, you still want to see company earnings positive. You don't really want to see them dip too much. I mean, we went from around, let's say 50 cents, and this is around, let's say 70 cents. So that's not bad. That's not a bad range. But again, I don't have the full numbers on me, so I can't really tell or compare. See, now this one is showing me for the annual. And again, these are 2021 results. As you can see here that they're giving me right here, 2021 results. So we're gonna keep looking. Net margins, that's very, very important. That's like my one of my favorite factors to look at. Debt is lower than most banks. Book value has gone up. Cash flow 2.7. Cash reserve not showing me. Net income has gone up, which is good. Revenue is not showing me. Again, operating, it's just hard to say because I don't have full information here. So as for cash flow, and again for 2021 results, showing me that. So I just add all that up, and you just see the difference. So we have 40, and so around 256. So they do have cash flow. So I will give them that positive rating for the value. And quality, I don't know. I wouldn't say quality, but we're gonna read a little bit about this company. So located in Ohio. If they were located or have more branches or divisions in other states, that would help. But I'm not too sure about it. So it only looks like Ohio. They're very dominant in Ohio. So it looks like a state bank. I don't know if they're national. So hopefully, if they're dominating in the Ohio market, hopefully they're taking over that market, and then one day and someday they can move on to another state and actually grow their business. That's how well-established businesses do it. So for this one, again, I'm gonna say no for watch list. Next one up is FULTP, Fulton Financial. We have here, not too bad. It needs slightly more work. Volume, I'm not too crazy about. PE. So the earnings per share, not bad. And it does cover the dividend. Dividend yield is not bad. I would like to see rising dividends. So for 52-week high and low, it needs a little bit more work. Again, a minimum standard that I'd like to see for any stock is at least a $10 minimum difference. And that's for the whole year. You know, a difference of $10. And that's me being generous. And typically, again, for stocks that are doing okay, like just barely making it, I'd like to still see a $10 difference. If it's close to it and you have good numbers, I might consider it. And the market cap is really low, but their earnings and dividends it looks like they pay most of their earnings in dividends. So we're gonna kind of look at that. So for the 5 year, it looks like it's dropped and then it's come back up. I'll look at the 1 year real quick. So it looks like it's starting to uh, come back up slightly, but then it's going back down again. So uh, we don't know what's going to happen with the stock market. It's been crazy this year, going down and it's going up again. This looks like a major index, and then now it looks like it's starting to reverse. Actually, these are big drops. So anyhow, going to move on to the quant rating. So again, fundamentals are okay. If I had to choose, I lean more to the yes. As for the chart, I'm gonna say no. Now for the quant rating, this is the tiebreaker. So either I'm gonna say yes or no to this overall. So total score for it is 5.65. Now for growth, I don't see growth. And again, it doesn't have to be the majority of these. A minimum standard, cause the majority vote would be 1, 2, 3. You would think it's 1, 2, 3, but actually, I would say 2, because some of these ratings go hand in hand. When it comes to growth and momentum, they go hand in hand. When a growth stock, even though they have good numbers and they're reporting earnings, that goes hand in hand with momentum. Meaning, if they're growing, that's a company that's, doing better than most. But on top of that, basically, it's telling you that it's more in demand. When there's more of a demand for that company and it's growing, no matter what the stock market says, whether, let's say, they beat their earnings and their revenue during our earnings day to report it, and let's say they beat the estimate for their earnings and their revenue, but the stock goes down. I mean, it'll still have momentum, I would assume, one way or another. It would slowly start gaining a little bit more momentum. And what I mean by momentum is the volume, because there's more interest in it. And the reason it has more interest from people is because it's more of a demand. Uh, Growth stocks are stocks that are in demand. I mean, it not always. Some people might consider it always, other people not. But one way or another, uh, growth is a demand. Growth stocks are a demand. So, eventually down the line, they just become good stocks. And this is why it's important to find these stocks beforehand, before they go up, and do a full evaluation and analysis, because when they start to grow and you see them starting to grow, over that 52-week high mark, and it just keeps breaking new highs, that's another thing too, that you start seeing that momentum that everybody wants to get in on the action when you already know if it's a good stock or not. So it's like you got to prepare beforehand to see what actually is going to happen. And you're not late to the party. You have no surprises. It's like when everything goes according to plan and you have everything set up before it happens, everything just runs smoothly and you have less worries. But if you see a stock going up and then all of a sudden, okay, what can I do? And at the moment you're kind of stuck, and it's like you're too late to jump into the party, because, you know, the the evaluation was already done beforehand. So this is what good fund managers do. They look at all these stocks. I wouldn't say they look as much as me, but they look at the most popular ones and they're always evaluating. I don't really see portfolio managers or fund managers doing that. They just, I guess they follow indexes and just look at a top 100 portfolio or mutual fund or whatever, and then that's it. They just pick and choose what stocks. They don't really do the research. So again, growth and momentum go hand in hand. So this is why I consider this just one rating. And then when it comes to value and income, I consider that another rating. And then quality is quality. That's just a rating on its own. Um, Quality I consider either you're a good company or you're doing okay and you want to be good and then you can still pass for okay, but a crappy company is a crappy company. So again, with value and income, if you're a good if you're well, sorry, if if you're a quality company, you're gonna have income. And then income comes in two ways. Um, it's in the form of dividends, and then also it's in the form of capital appreciation, which is price movement, stock price going up. So again, when people think of income, they think of, the dividend payments. Yeah, that's true. But then there are stocks. The whole point of the stock market for some people too, not everybody, there's people that do short term trading and then they consider capital gains income. There's people that make a living off of this. We all know that. And then whether it can be a few $100s, thousands of dollars, it's still considered an income. So again, quality and income go hand in hand. If you find a quality company or an okay company that you can still see where it's sort of doing better than before, last earnings, then they're bound to do better. And then again, uh, it sort of has to do with growth, but not as much. Growth is only just a small aspect of what the company has to offer, and that's just based on, reinvesting in the company or whatever. But just the company itself, is the company essential? You ask yourself these questions. Is it a company that people want, or it's a company that people need? Because if it's a want, then it's an automatic no. Is this a company that is in demand? Or is this a company where you can just buy something from this company or service from this company like just one time and then never buy from it again? You know, is it a company where what I mean is it makes you want to keep buying, not because, well, it could be because of interest, but the thing is that um when it's essential, it's just something that you need. So when it's something that you need, you're more likely to keep buying repeatedly because we need it, just for basic living or expenses. And this is just for our, daily lives and normal routines. So a quality company is just going to be a quality company. There are quality companies that exist now where they, like, for example, I saw an advertisement where a guy was talking about a car rental business, and then he started his own car rental business. And I'm thinking, why would he start his own car rental business if that already exists? But the thing is that I'm not bashing it, but what I'm saying is, um, if there is a better way to do business, better than a current business that's doing it already, because they don't have a competitive advantage, or they're not making business easier for them and their customers, then any sort of advantage creates a quality company. So again, with a competitive advantage, or something that has to do with slight creativity, whether it could be technology or just a certain licensing or certain idea where they just, do something better than, an older company. Um, Obviously, newer companies are always trying to find better and more important ways to do things. And then old companies, sometimes they just like to stay the same. They like to have the same rules. They like to have the same, everything. They just don't like to deal with change because they're just comfortable with what they have and what they're doing. Um, Good businesses do that. They adapt to change, and then some companies don't do that. They just fall behind, and then eventually they die out. So I would like to say that, for example, so many companies in the stock market, how many of these companies in the stock market now in 2022 are still in the stock that are still in the market that started like 30 years ago? 30 years is somewhat of a, I wouldn't say it's a long time or it's not a short time, but it's some time. So what I'm saying is, for a company to last, you have to be doing something right. There's very few companies now that, let's say you invest in a company right now, right? A brand new company, right? Um, and they're doing really good. Let's say, for example, Facebook. Facebook came out, like, let's say, 12 years ago, 15 years ago. Who's to say that that Facebook is still going to be around the next 20 years? Because just because a company was around in our lifetime doesn't mean it's going to be around in the next lifetime or the next generation. So what I'm saying is, in order for a company to grow, they need to adapt to change and better ideas. It's okay to keep certain rules or ideas and, you know certain aspects of daily routines for business and daily operations, but eventually, as time goes on, just it's just normal. Things change. People like different things, and things, are done easier just because of technology. Technology has played so much of a part in our daily lives that it just, you know, it just makes things easier. So again, that's why I want to say quality and income go hand in hand, because the better company you are, whether it's capital gains or dividends or both or just either way, it's still a price movement. That's still considered income. So those two go hand in hand. And then, to me, in my personal perspective, I still think growth and momentum go hand in hand, because growth is more like how fast. Because it could be a stock could be doing really good. Let's say every year they're doubling revenue, they're doubling their net income, they're beating earnings like every year for the past like 7 years, but they get no attention from Wall Street. And what I mean by that, there's no personal interest from it from other investors. So the volume is really low. But then, like, let's say their earnings have grown even more in year 8, and then for some reason As soon as volume goes up, that's when growth starts to kick in because more people are just interested in that stock, whether it goes up and down. It's just a matter of stock selection, and it's a matter of people having a liking to the stock. That's all it is when it comes to short term trading and investing. In the long run, it's totally different. Um, it's harder for like if a company has low volume and they could be paying really good in income, and I've have companies in my personal portfolio that are like that, and I've never seen volume kick up a lot. It just stays the same, the same, the same, the same, the same, and then there's just no interest in the stock. But that's just the way it is. I mean, in a way, it can be a good thing because nobody really hears about it, and that's more shares in your pocket. But then again, you can look at it as a perspective where, wow, like the price movement is so slow that imagine if it had more movement because they have more personal interest of people buying that stock. But that's just the way of the game, that's just the way of the market. People have their preferences and choices and their likes and dislikes, and that's just the way it is. So again, quality and income, I rank that as one rating, and again, uh, growth and momentum, I count that as another rating. And then the value is actually uh, the price you pay for that stock, because you need to know how much something costs before you buy it. Are you overpaying for this stock? Are you paying normal value, or are you paying below and you're getting a discount? Are you paying less than what it's actually worth? So that's why you gotta you know look at these numbers and say to yourself, are you getting a good price for it? So again, we're gonna look at the chart, and like I said, the last 5 years it's been flat. Hold on. So actually, this stock has only come out in up to 2021. Actually, 2020, late 2020. But again, for the most part, the last 3 years, um, I would say it is a good value. But for the stock, we're gonna look at that real quick. So they have been paying a dividend since 2021. Usually banks do that. But what I don't like, again, 32 cents since 2021. There is no dividend, uh, you know, income for rising dividends. It's been the last 32 cents for the past 2 years. So rising dividends is a big no-no for me. I'm gonna say no. So apparently the stock is a no. And hopefully their market cap goes up. So sorry I took so long, but that's just my take on it. I just hope you learned more about the quant ratings as to all the feedback that I just explained a few minutes ago. And I hope you guys understand where I'm coming from. And I just hope it makes sense. So the last two stocks that I have are COOP, COOP. So let's see what this stock is. Consumer lending. So I'm trying to read what they are involved in. So they're more into the real estate, as you can see here. Let me move my picture. So as you can see here, it says, on behalf of investors, owners of underlying mortgages, includes collecting and dispersing. So they like to borrow and modifying loans. It almost looks like they like to invest in real estate and pay off homes and flip them or something to its direct to consumer, and provides refinance options. And they purchase or originate loans from mortgage bankers. So, something like that. It's like they like to buy land and use that land to sell homes. I think that's what I'm getting out of this. Or they buy the land and they probably sell it for more so people can build. Strictly, they can only build houses on that land after they buy it. Obviously, they're going to sell that land for a little bit more money to whoever wants to build on a house or buy um, the house beforehand, whether it's just a land on it only or whether the house is built or not. Or maybe they just might have, um, you know, the land, but then it's well kept and they already dug out what they wanted to dig out, the trees and all that, and, probably took care of that. So, oh boy, in Q2 2022, this is a big drop. So they went from positive to negative earnings. That's a real no-no. This company is a over $3 billion company. They're not paying a dividend. Earnings are pretty strong, but I'm gonna have to say no automatically just because that is a big drop. So not only did they go from positive to negative, they went from about, let's say, like $1 all the way down to like uh negative 9, I'd say, around 9. That's really not a good sign. That really is a big loss. So momentum wise, it looks like they're pretty popular as a bank. Their PE, that's very, very, very cheap. And for, let's see, I'm going to look at the chart again. So for the 5-year chart, as you can see, wow, this is a strong stock actually. This is a pretty strong stock. So as we can see here, a lot of choppiness. But if we look at the last 5 years, pretty strong growth. It's dipped below the 50 moving average. So this would have been a good price range. So around here. So we're looking at about $40 high and about $30 the lowest. So that's the range between $30 and $40. So as we can see here again with the analysis, income, they have nothing, but I'm not gonna count income out because I still see it has a price obviously, so it's worth something. So for the price and the income, it looks like it's doing pretty good. Momentum, I'm gonna say it does have momentum. The value, I'm gonna have to agree with that. It's very, very, very cheap with that 2 PE, very, very cheap. Growth, I don't really know, but the quality company, I'm gonna say, let me just read about it again real quick. I mean, the growth, this is what screwed up the growth right here. As you can see, the negative 10, that's just this quarter alone, that really is a big drop. That's really gonna ruin it. But again, as for the stock itself, again, they're into real estate. So real estate is always a solid selection when it comes to, investing in a, in loans and stuff like that. Sorry, I'm just reading a little bit again. Just trying to see. So yeah, it looks like they're just doing real estate. So again, they don't pay any dividends. The last time they had a split was in 2018, 1 for 12. Um, well, I would love to dig into the numbers, but they just don't give me the numbers. I wish I could dig into it more, but it's just not letting me. For the revenue, it actually gave it to me. So for net income, as you can see, it's gone up in 2021, but in 2019, it's just really, really low. And again, 2018 went high. So it went from high to low and then went flat those 2 years. Then it went high again. That's very, very just, I want to say random, but it's just very, unstable. It's not really holding up like it should. Operating income does hold up. So we're going to look at their debt. The debt levels have gone down a lot for the balance sheet, which is good. 76% debt. It's still too high, I think, but it's better than the years before that, which is just amazing. Really, really good. I'm happy for that. And hopefully they continue to do better and manage their money better. So as for cash flow, they have, let me see. So 19 and 6. So that's about 80. So they do have just a wee bit of cash flow. It's positive, but it's not much. And hopefully they're doing the right thing and a good thing. Um, I don't know. It's just really, I'm going to have to see what they do for the third quarter and the fourth quarter. So obviously the 52-week high and low is pretty good. Momentum. It's good, and the market cap I like. Again, this is the 52-week high and low difference of $10. Um, Overall, the company seems okay. They just need work. Um, this is the kind of company where it's like 50-50. Like, it's an okay company and they need work, but it's like, do you say yes and do you risk it, or do you say no and play it on the safe side and then put it away? So I'm gonna play it on the safe side and say no. I'm gonna say no. Not for a watch list as of right now. Put it away for this year. It didn't make the list for this year for a watch list. Very close to it, but hopefully in Q3 and Q4 their earnings are better. And then this year has been an awful year thus far, so I'm not gonna take that chance. And who knows? Maybe with the volume, the price might go up. But again, as for the numbers and the company itself, it just needs to improve. And sometimes it's like that. The company could be doing worse, and the share price goes up, and it's just a matter of personal interest. And then people just still like the stock because it could be because it's cheap and other people are making money, and it's just a hot stock, and that's just what it is. But again, behind the short term, looking into long term, it might not be a good stock. So I'm gonna say no, and hopefully next year we can see this stock. Hopefully I remember to review it and we can go over it. So the last one up is SLM, and we have that at $15.56. Market cap is at 3.91. That's good. 52-week high and low. I'm not really liking that. PE I do like, very undervalued. The EPS, earnings per share, that's a nice strong number to see. And again, based on the market cap, that's really not that bad for the earnings. And then a dividend payment of 44 cents. I don't really like that. So some of the numbers I do like, some of the numbers that I don't. As for volume, it looks like it has momentum now. So obviously the share price is gone up. That's not a surprise. I don't even have to look at the chart to see that. Just by looking at the volume and a little bit of the 52-week high and low, and then again, this is slightly going better. And what I mean is, like, right here, you see these big surges, and then it passed in 2020, it passed that line and it just surged up. But now, as you can see, it's going there. And then for the overall, went down and then started to go flat again. So this little surge here, this little surge right here, let's look at that again. So we had that little surge from about so if we draw the line from here to here, so that is from about, so yeah, wow, I'm surprised. So that's the end of 2021. It went up and then it actually broke down in April. So we're gonna look back for the last year, and again, you see these big surges, and then it's just going down slowly. It goes down. So it looks like the company's doing okay for personal interest as a company in the stock market, but as a company outside of the stock market, like just viewing it as a company itself, um, it looks okay. We're gonna see the 5 year again. So for the overall, it's going down slowly. And again, this is not a big move in price. I mean, again, it looks like it's a really nice chart. It is a really nice chart, and it's going down slowly. But the thing is that when you look at the numbers, the price, so you went from 12 to about $20. That's not bad. $8 difference from 2020 to 2021, not bad. And then it's slightly going down this year. So we're gonna look at the analysis real quick. So again, I wish I had better numbers. So income, I'm gonna say no. I do not like the income. The momentum I can agree with. The value, I'm gonna take a look at this real quick. As for growth, I'm gonna say no. As for quality, I'm gonna take a look at that. So quality and value. So quality and value. So for the quality of this stock, they do pay dividends, rising dividends. So in 2021, they went from 3 cents to 11, but prior to that, all they've been paying is 3 cents since 2019, as you can see. So basically, this company is not a company that pays rising dividends. Rising dividends would either be every year or maybe an increase twice in a year. So, or an extra payment along with rising dividends for the year. Like, for example, like if you see my videos of special dividend, one time a year along with rising dividends. Those are those very, very few companies that are really, really good. And you really don't find them. Those are those rare elite companies, you know. So we have here, so there's still positive earnings. We're gonna look at the annual. Doesn't look like they have annual. I'm not getting anything. So net income looks good. Revenue I don't have. The debt keeps going up. That's not a good sign. Their cash flow, we're gonna look at that real quick. So negative 49 million. They have negative cash flow. So we're gonna go back to the analysis. the quality I'm gonna disagree with. Their cash flow has gone down. Um, their earnings still need to be reported, but just from their cash flow alone and their debt, it's a no-no. That could change with their earnings reports, but even then, gonna say no. Uh, their growth, again, overall, they've gone down. So all they have for them is their momentum and value. So overall, I'm gonna say no for this company as well. But I want to see if they do have some value. So what do they do? The company is the brand for college and continuous education. So so basically, this is a company for student loans. This is a company for student loans. So if you like companies that actually like student loans, getting students into debt, this is a good company. Um, well, decent company. I wouldn't say good, but this is one of the public companies. Um, Again, with with the job market right now, there's more people that like to work for themselves. There are still people that still believe in going to college. I still think so. I've went to college, but again, we're more in a different time now, and then this generation now um, wants to not go to college, and they want faster success. They don't believe in like hard work and all that. They just want to hit the skip button and jump right to success, and things just don't work that way. And if they do work that way, there are very, very few people that are successful, that have done like TikTok accounts and blew up and stuff. And I think a little bit, I would have to say takes luck. A little bit takes skill, and persistence. And again, it just doesn't happen overnight, and it just doesn't happen for everybody. So what I'm saying is, it takes time, and then even if you do put the time into it, uh, it's just not meant for everybody. And then even if they do succeed, um, question is, do people really want to do this for this in their entire life? Like they want to be known for posting their entire life on YouTube for the rest of their life. That's how they want to be known as in this world, you know, to to be as a human being. You know, you want to be known as somebody who just posted everything every time, anywhere for their whole life. There's just no, first you have no privacy and there's just no enjoyment. After a while, people do get bored of watching the same videos. People don't watch the same, people just don't watch one channel. People watch multiple channels, like a TV show, and people have different interests. Interests change. So, you know, good luck to them if you want to be, a YouTube star for the rest of your life. I can understand for a few years, whatever. It is what it is. But um, if you want to make a career out of, you know, drama and posting everything online, then more power to you. But it's just not a comfortable lifestyle for the rest of your life. You want to just, be a better person and be better than that as, you learn and grow for yourself. So aside from that, hopefully this company learns and grows. I just don't like companies that take advantage of stuff like that. So again, they're in the consumer lending business. So I'm gonna say no to this stock, and I'll just leave it at that. Again, they're very popular in personal interest. People do like this stock. I don't like it, but other people do. I clearly see the numbers supporting it. So again, overall, I'm gonna say no to this stock, but other people are saying yes. Not for the long term, but obviously for day trading purposes and for the short term, maybe for the medium term. Either way, it's still less than a year for personal interest in this stock. So there we have it. Those are the 5 that I have. Sorry it took so long, but this is the info that I have. Again, I provide all those factors when it comes to fundamentals, technicals, and quants. I hope you guys enjoyed the video. I know I talk too much, but it's just very important information to give you guys. And I'll see you guys in the next one. I'm still going to continue the banking services sector. Again, there's so many banks and hundreds of banks to go over. This is like the largest sector out of everything. So hopefully I can finish this and we will continue into other sectors. So thank you guys for watching. I hope you guys learn from my channel like always. Like, comment, subscribe. If you don't, watch my shorts and I'll make a shorter and better video and a summarized video for this. So stay tuned and take care. I'll see you guys in the next one.